Picture this. October 24th, 1929. A regular Thursday morning in New York City. Thousands of ordinary Americans wake up thinking they're wealthy. They own stocks. They're part of the great American dream. By lunchtime, their entire world will collapse. Within hours, the stock market will lose billions of dollars. Families who were comfortable at breakfast will be destitute by dinner. Some will end their own lives before the sun sets. This wasn't supposed to happen. The market only goes up, right? Everyone said so. The newspapers, the brokers, even the shoeshine boys were giving stock tips. But here's the thing that nobody talks about. The crash of 1929 wasn't caused by some external shock, some unexpected disaster. It was caused by the very mechanism that everyone trusted to make them rich, the stock exchange itself. And if you think that was just a one-time historical accident, you need to understand something crucial. That same mechanism is still running today, right now, on your phone, and it's doing the exact same thing. Hold on, before we dive into this research, I need to know something. Where are you joining from, and what time is it there right now? Country, city, local time? Put it all in the comments below. I really want to see how global this is. Let's go back to the beginning. Way back. Because this story doesn't start with Wall Street or with computers or even with America. It starts in medieval Europe, in dusty marketplaces where merchants were trying to solve a problem that would eventually reshape human civilization. Imagine you're a merchant in 10th century Europe. You've just spent months traveling dangerous roads, your cargo of grain vulnerable to bandits, storms, and rot. You finally arrive at the market, exhausted and broke from the journey. And then you discover the price of grain has crashed. Maybe there was a good harvest. Maybe another merchant arrived yesterday with twice as much grain. You're ruined. All that risk for nothing. Now multiply that anxiety across thousands of merchants, and you begin to understand why trade was so unpredictable, why economic growth was so slow, why people were terrified of commerce. The smartest merchants started meeting in advance. They'd agree on prices ahead of time. 6 months from now, I'll deliver you 100 sacks of wheat. You'll pay me this amount. No surprises. No panic. These were the world's first futures contracts, though nobody called them that. They were just people trying to sleep better at night. These agreements needed a place to happen. Somewhere everyone trusted. Somewhere with rules. Enter Bruges, Belgium, 15th century. In this wealthy trading city, there was a family of merchants and bankers named Van der Beurs. Their family crest? 3 purses. Perfect symbolism. Merchants from across Europe started gathering at the Van der Beurs house to make deals, exchange bills, get news. The house became so famous that people started using the family name for the activity itself. In Dutch, Beurs became Beurs, which became Bourse in French, Borsa in Italian, and eventually exchange in English. The word stock exchange is literally named after a Belgian family's house where people made deals. But Bruges was just the beginning. The real revolution happened in Antwerp, another Belgian port city. In 1531, they built the world's first purpose-built exchange building. High arches, a roof to keep out the rain, and actual rules posted on the walls. For the first time in history, there was a dedicated physical space just for trading. And they weren't just trading grain anymore. They were trading currencies. Because Europe was a mess of different kingdoms, each with its own coins. If you wanted to trade across borders, you needed money changers. These currency traders in Antwerp were essentially running the world's first forex market. No computers, no charts, just people shouting prices in a hall. But here's where it gets interesting. All of this, everything up to this point, was about real physical things. Grain you could eat, coins you could hold. That was about to change forever. Because in the Netherlands, Someone was about to invent something that would transform trading from a practical necessity into a psychological phenomenon. They were about to invent the stock. Amsterdam, early 17th century, the richest city on earth. The harbor is packed with ships bringing spices, tea, tobacco, and silver from literally every corner of the world. Silver was the dollar of that era, the global reserve metal. Gold was for kings and treasuries. Silver was for actual trade. And in 1602, the Dutch created something unprecedented. The Dutch East India Company, known as VOC, the world's first publicly traded company. Here's why this was revolutionary. Previously, if you wanted to fund a trading expedition, you needed to be rich enough to buy a ship, hire sailors, and wait years to see if they came back alive. Most people couldn't do that. But the VOC sold shares, small pieces of the company. You didn't buy a ship. You bought paper. That paper gave you a right to a portion of the profits when those ships returned, loaded with spices. For the first time, regular wealthy citizens, not just dukes and counts, could invest in a massive corporation. This is what we now call an IPO, initial public offering. A company raises money by selling shares to the public. Investors get dividends from profits, or they can sell their shares to someone else if the price goes up. And that's exactly what happened. The Amsterdam Stock Exchange was born, real people trading real shares every day. But something unexpected happened. People weren't just buying shares for the dividends. They were buying them because they thought the price would go up. They were buying them to sell them to someone else at a higher price. This is speculation. And speculation is driven by something far more powerful than facts. It's driven by emotion, by stories, by belief. The metaphor of bulls and bears was born in England around this time. Bulls thrust their horns upward. Bulls bet that prices will rise. Bears swipe their paws downward. Bears bet that prices will fall. And these early traders, these ancestors of modern investors, they weren't just analyzing balance sheets. They were spreading rumors, telling stories about ships that had sunk or treasure that had been found, anything to move the price. Because if you could convince enough people that a price would go up, the price would go up. Not because of reality, because of belief. And this brings us to one of the most insane economic events in history. An event so ridiculous that economists still study it 388 years later. An event that proves that human beings will never, ever learn. The Tulip Mania. Netherlands, 1630s. The Dutch are the richest people in Europe. They have more money than they know what to do with. And suddenly, tulips become fashionable. Not just any tulips, rare ones with unusual colors and patterns. Wealthy merchants start competing. Who has the most beautiful tulip garden? It becomes a status symbol. And then, inevitably, speculators arrive. People start buying tulip bulbs not to plant them, but to sell them. Prices start rising. More people join in. Nobody wants to miss out. They're buying futures contracts on bulbs that haven't even grown yet. At the peak, a single rare tulip bulb cost as much as a house in Amsterdam. A craftsman who earned 300 guilders a year would pay thousands for a flower bulb. People mortgaged their homes, took loans, sold businesses, all for tulips, because everyone knew the price would keep going up forever. Until February 1637. At an auction, nobody bid. The price collapsed. Within weeks, tulip bulbs were worthless. Thousands of people were financially destroyed overnight. This was the world's first recorded speculative bubble. The first time a market went completely insane and then crashed spectacularly. You'd think people would learn from this. They didn't. They never do. Because less than a century later, in London, an even bigger disaster was about to happen. London, early 18th century. Coffee houses everywhere. This is where business happens, where news spreads, where deals are made. And in 1711, a company was founded that promised to make everyone rich: the South Sea Company. This company had exclusive rights to trade with South America. Spanish colonies, rich in silver and gold. The only problem? England didn't control those territories. Spain did. And Spain wasn't exactly welcoming English traders. But who cared about details? The share price was rising. Lords, dukes, even members of the royal family were buying. The price increased tenfold in months. Common people sold their homes to buy shares because their neighbors were getting rich and they couldn't stand being left out. Even Isaac Newton, one of the smartest humans who ever lived, bought shares. He later said, "I can calculate the motion of heavenly bodies, but not the madness of people." And then, inevitably, the bubble burst. When it became clear that there would be no South American riches, the price collapsed. Thousands of aristocrats and merchants lost everything. Families were destroyed. Some people committed suicide. But something good came from this disaster. England finally started regulating its markets. They created rules about what companies had to disclose before selling shares to the public. They tried to prevent the most obvious frauds. And slowly, London transformed itself into the financial capital of the 19th century world. One interesting practice emerged in London. Short selling. Traders would borrow shares they didn't own, sell them at current prices, wait for the price to fall, buy them back cheaper, return them to the lender, and pocket the difference. You're literally betting that something will fail. Making money from disaster. It seemed immoral then. It still seems immoral now. But it's legal, and it's everywhere. This is how modern finance works. But our story now crosses the Atlantic, to a young country that would eventually dominate global finance so completely that every market on Earth would rise and fall based on what happens in one city. New York. 1792. New York is small, dirty, a former British colony trying to figure out what it wants to be. On Wall Street, literally a street where there used to be a wall, 24 brokers and merchants meet under a buttonwood tree. They're tired of being cheated by unscrupulous traders, so they sign an agreement. We'll trade with each other honestly. We'll charge a standard commission. 24 men under a tree. That's it. That's how the New York Stock Exchange was born. Nobody thought it would become the most powerful financial institution on Earth. At first, they traded in the streets, shouting prices, shaking hands, like a farmer's market, but for stocks. Eventually, they rented a room, then a building. By the mid-1800s, they were trading shares in railroad companies. Railroads were the tech stocks of the 19th century. Everybody wanted in. By 1900, America was an industrial superpower, and Wall Street was where you went to own a piece of that power. In 1901, banker J.P. Morgan created the first billion-dollar corporation, U.S. Steel. $1 billion. In 1901, adjusted for inflation, that's about $35 billion today. Steel was everything. Buildings, railroads, ships, weapons. Owning U.S. Steel was like owning a piece of America itself. Wall Street created something else that's now universal: stock indices. The Dow Jones Industrial Average, created in 1896, tracked the biggest companies. It became a thermometer for the entire economy. If the Dow goes up, America is healthy. If it goes down, something's wrong. It's still reported every single day on every news channel in the world. And this brings us to the event that changed everything. The event that proved that unregulated markets are fundamentally dangerous. The event that forced governments to finally step in and control the madness. The 1929 crash and the Great Depression. America, 1920s. Everything is perfect. World War I is over. The economy is booming. Electric lights in every home. cars on every street, jazz music, movies. Everyone is getting rich in the stock market. Ordinary people are buying stocks, secretaries, taxi drivers, shoe shiners. Everyone has a tip. Everyone knows a company that's about to explode. And here's the dangerous part. They're buying stocks with borrowed money. You only need to put down 10 or 20% of the price. The rest is borrowed from your broker. This is called buying on margin. Leverage. If the stock goes up, you make massive profits. If it goes down, you lose everything and still owe the loan. But nobody thought about that second possibility, because stocks only go up. Right? October 1929. Something shifts. A few big investors start selling. Prices drop slightly. More people sell. Prices drop more. Panic begins. October 24th. Black Thursday. The market drops 11% in one day. October 29th. Black Tuesday. The market drops another 13%. Within weeks, stocks have lost half their value. People who were wealthy on Monday are broke by Friday. Banks that lent money for stock purchases can't collect. Banks fail. When banks fail, depositors lose their savings. When people lose their savings, they stop spending. When they stop spending, businesses fail. When businesses fail, workers lose jobs. When workers lose jobs, they can't pay debts. The entire economy collapses like dominoes. By 1933, unemployment in America reached 25%. 1 in 4 Americans had no job. Families lived in tent cities. People stood in bread lines for food. This wasn't just a stock market crash. It was a civilizational catastrophe. And it was caused, fundamentally, by greed and an unregulated market. The government finally learned the lesson. They created the Securities and Exchange Commission in 1934. The SEC. Its job? Make sure companies tell the truth about their finances before selling shares. Ban insider trading, where executives profit from secret information. Prevent pump and dump schemes, where traders artificially inflate prices and then sell. Require brokers to follow margin rules so people can't borrow unlimited money. Separate investment banks from commercial banks so people's savings aren't gambled. These rules made markets safer. Not safe. Safer. But they didn't eliminate human nature. Fast forward. The markets recover. The future World War II ends. America becomes the richest, most powerful country on earth. The stock market grows with it. Investing becomes respectable. Middle-class families buy mutual funds. Retirement savings go into stocks. Wall Street becomes the engine of American prosperity. By the 1970s and 80s, new innovations arrive. Index funds, options, derivatives, financial instruments so complex that even the people trading them don't fully understand them. And then, computers. Everything changes when trading moves from humans to algorithms. Computers made trading faster. Much faster. In the 1980s, if you wanted to buy a stock, you called your broker. They called the exchange. A human being matched your order. It took minutes. Now, a computer can execute a trade in microseconds, millionths of a second. High-frequency trading firms spend millions of dollars to shave nanoseconds off execution time. They build fiber optic cables in perfectly straight lines between cities to get data a fraction of a second faster. Why? Because if you know a price a fraction of a second before everyone else, you can profit. There's even a movie about this. The Hummingbird Project. It's about traders laying a cable from Kansas to New Jersey to gain milliseconds of advantage. That tiny edge is worth billions. Today, according to 2025 market data, the New York Stock Exchange handles an average of 1.36 billion shares per day. NASDAQ, which focuses on technology stocks, trades over 9 billion shares daily. The global stock market is now worth approximately $145 trillion as of October 2025. That's more than the GDP of the entire planet. And here's the critical part. Most of that trading, somewhere between 50 and 70% depending on the market, is done by algorithms, not humans. Robots. These algorithms can analyze millions of data points, recognize patterns, and execute thousands of trades per second. They react faster than any human possibly could. When the market moves, algorithms amplify that movement. If prices start falling, algorithms sell. That causes prices to fall more, which triggers more algorithms to sell, which causes prices to fall even more. Remember the flash crash of May 6, 2010? The Dow Jones dropped 1,000 points in minutes, wiped out nearly $1 trillion of value, then recovered most of it within the same day. It was caused by algorithmic trading, a feedback loop of machines reacting to machines. Humans couldn't even understand what was happening in real time. And this brings us to something crucial, something most people never think about. If you've never bought a stock in your life, you might think stock markets don't affect you. You're wrong. Stock markets determine everything. If markets are healthy, companies can raise money easily. They build factories, hire workers, salaries increase, retirement funds grow. When markets crash, companies can't get funding. They lay off workers. Banks stop lending. Mortgage rates increase. Your job, your salary, your rent, your retirement, everything is connected to what happens in these markets. The stock market is a barometer of economic confidence. When investors flee, it signals something is deeply wrong. Conversely, when markets soar to record highs, it often signals irrational exuberance. Bubbles forming. Remember the dot-com bubble of the late 1990s? Companies with nothing but a website and a .com domain name were worth billions. Pets.com. Pets sold pet food online. It went public. The stock soared. Then the company failed spectacularly, lost hundreds of millions. The stock became worthless. But for a brief moment, it was valued higher than established companies that had been profitable for decades. Why? Because people believed. And in markets, belief is often more powerful than reality. Think about today. Right now, in October 2025, you can open an app on your phone and buy shares of Apple, Tesla, Bitcoin futures, commodities, currencies. You can trade Japanese yen while sitting in Kansas. You can short sell European stocks from your bedroom. The entire global financial system is at your fingertips. And yet, despite 500 years of market evolution, despite regulations and technology and education, most people still lose money. According to the most recent data from 2025, approximately 70 to 80% of retail traders lose money in the long run. Some studies suggest the number is even higher for day traders, approaching 90%. Why? Because markets are still driven by the same forces that caused tulip mania in 1637. Fear, greed, the irresistible belief that this time is different, that you're smarter than everyone else, that you can time the market. You can't. Almost nobody can. Professional investors with teams of analysts and supercomputers struggle to beat the market consistently. Yet millions of amateur traders think they'll be the exception. The market is always right. That's one of the fundamental truths of trading. The price of an asset at any moment is the equilibrium point where buyers and sellers agree. If someone is buying, someone else is selling. For every winner, there's a loser. Trading is a zero-sum game. Actually, it's worse than zero-sum. Because of fees, commissions, and spreads, it's negative sum. The house always wins. And the house is the brokers, the exchanges, the high-frequency trading firms with their billion-dollar server farms. They extract value from every transaction. So for you to profit, you need to beat other traders and cover the fees. Good luck. But here's what's truly fascinating. We know all this. All of this information is public. We know that 70 to 80% of retail traders lose money. We know that markets are driven by emotion. We know about every historical bubble and crash. And yet, the same patterns repeat. Every few years, there's a new mania. In 2000, it was internet stocks. In 2008, it was housing and mortgage-backed securities. In 2021, it was cryptocurrencies and meme stocks. GameStop, a dying video game retailer that briefly became one of the most valuable companies in America because retail traders on Reddit decided to punish hedge funds. It was insane. And people made fortunes. And people lost fortunes. And nothing fundamentally changed. Because at the core, markets are not about rationality. They're about human psychology. And human psychology hasn't changed since the Dutch were buying tulips for the price of a house. We still experience greed when we see our neighbor getting rich. We still experience fear when prices start falling. We still believe we're special, that we've found the secret, that we're going to be the ones who get rich while everyone else loses. This is why financial education is important, not so you can get rich trading, but so you understand the system, so you don't make catastrophic mistakes, so you don't mortgage your house to buy cryptocurrency at an all-time high, so you don't panic and sell everything during a market dip, so you understand that long-term, diversified, boring investing is actually the strategy that works. Warren Buffett, one of the most successful investors in history, has a simple philosophy. Buy good companies, hold them for decades, ignore market fluctuations. Don't try to time anything. Be patient. His strategy is boring. It's not exciting. You won't get rich overnight. But over 30 or 40 years, it works. And yet most people can't do it. Because it's boring. Because they want excitement. They want the thrill of winning big. They want to beat the market. They want to prove they're smarter than everyone else. And that's why they lose. So let's bring this full circle. We started with the Great Depression, with people waking up thinking they were wealthy and going to bed destitute. That still happens today. Different technology, same human nature. The stock exchange, this mechanism that started with merchants in medieval Europe making simple deals about grain, has evolved into a $145 trillion global system. It's built the modern world. Railroads, factories, cars, computers, smartphones, artificial intelligence. None of it would exist without capital markets, without the ability to pool money from millions of small investors to fund massive projects. So the stock market is essential. It's the engine of economic growth. It's also dangerous. It amplifies human emotion. It creates inequality. It rewards luck as much as skill. It allows sophisticated traders with billion-dollar systems to exploit regular people. It generates crashes that destroy entire economies. Both things are true simultaneously. Here are 3 clear conclusions. First, markets are more efficient than any alternative we've discovered, but efficiency doesn't mean fairness. Second, the same mechanisms that enable economic progress also enable catastrophic bubbles. And third, human psychology, not technology or regulation, is the ultimate driver of market behavior. The warning? If you think you're going to outsmart the market, you're probably the one being outsmarted. If your investment strategy relies on finding the next big thing before everyone else, you're gambling, not investing. If you can't explain why you're buying something other than because the price is going up, you're setting yourself up for disaster. The thoughtful conclusion? Markets are a mirror. They reflect our collective hopes, fears, greed, and stupidity. They don't create these things. They reveal them. Understanding markets isn't just about money. It's about understanding human nature. And that, ultimately, is the most valuable lesson of all. Thanks for watching till the end. If you're here, you're one of those who want to understand how the financial system really works. Subscribe, new research tomorrow, and drop a comment. What do you think about this? Your perspective matters.